All right, let's jump right into this. Picture this. You've just opened up a small custom clothing store. You know how to design beautiful pieces, you absolutely know how to sell them, and you've even managed to build up a super loyal customer base. But then you hit a wall. You're suddenly facing the really hard questions. Exactly how many garments do you need to sell this month, literally just to cover your rent, your electricity, and your salaries? What happens if you're relying entirely on your gut feeling to make those critical survival choices? Well, that's exactly what we're tackling in today's explainer on managerial accounting. We're going to build the strategic framework you need to finally stop flying blind and start navigating your business with absolute precision.
To do this, we need a massive paradigm shift. Think about financial accounting as basically staring into your rearview mirror. You're looking backward into the past to create reports for external folks, right? We're talking investors, banks, the tax authorities. Managerial accounting, on the other hand, is your windshield. It is completely forward-looking, strictly internal, and highly strategic. So instead of just trying to comply with external rules, you're actively transforming your internal data into really intelligent decisions. It's a total game changer.
So here's our strategic roadmap for today. First, we'll build out the control panel. Then we'll dive into costs and the break-even point. Third, we'll open up our strategic decision tools. And finally, we'll map out the managerial cycle. Let's get to it.
Part 1, the control panel, navigating the business. Remember, managerial accounting is basically your internal GPS. It all really boils down to answering 3 core operational questions that every single business just has to ask itself daily. Number 1, what is happening right now? That's your performance monitoring. Number 2, where are we actually going? This covers your resource and goal planning. And number 3, how do we course correct if we drift off track? That's all about taking swift control and making those corrective decisions. Managerial accounting isn't just a bunch of dry math. It gives you these powerful lenses to truly understand your organization's internal economy. Moving on to part 2, costs and the break-even point, or as I like to call it, finding your survival line. This is where we lay down the foundational tools to make sense of your expenses.
Let's go back to our custom clothing store for a second. You already know your fixed costs, things like rent and base salaries, are going to remain exactly the same whether you make one single shirt or 1,000 of them. Your variable costs, however, like your fabric and your packaging, scale right along with production. Getting your data cleanly structured around this specific distinction is absolutely the bedrock of taking financial control. And once you've cleanly separated those fixed costs from the variable ones, you can accurately pinpoint your break-even point. By definition, this is the exact moment, the sweet spot, where your total revenues perfectly equal your total costs. Now, at this point, you aren't making a gain, but crucially, you aren't taking a loss either. It's the vital metric telling you exactly how many garments you have to sell just to keep the lights on. It is exactly 0. Now, I know it might seem a bit counterintuitive to aim for 0, right? But in managerial accounting, hitting this 0 is your literal survival line. It's that absolute crucial milestone you have to cross before you can even begin to think about generating a profit. Everything before this number is purely about survival. Everything after it is growth. Part 3, strategic decision tools, your navigational toolkit. Let's shift gears from basic survival into the tools you need for complex, high-stakes decisions, like deciding whether to drop cash on a faster printing machine. You've probably heard the old saying, a euro today is worth more than 2 tomorrow. Well, in business, this is a massive financial principle known as the time value of money. If you're deciding between buying machinery right now, opening up a brand new branch, or launching a new product line, you absolutely have to calculate the present value of those future cash streams. This lets you build long-term capital budgets with the actual mathematical certainty that your returns will outweigh the cost of the money and the risks you're taking on. Now, how does this apply to budgeting when things change? Well, a rigid budget assumes you're going to sell an exact specific number of units, let's say 1,000 shirts. But if the market dips and you only sell 800, a rigid budget just completely breaks. A flexible budget, though, adapts to your actual level of activity. It's literally like your GPS recalculating the route when you hit heavy traffic. This is incredibly powerful because it tells you if you actually manage your resources well, entirely separating your actual management skill from pure market luck. So, what do you do if a client suddenly demands a huge volume discount? Or what if you're trying to decide whether to manufacture a component in-house or just buy it from a supplier? For these kinds of non-routine decisions, you need filters. You need to focus on relevant costs, the costs that will actually change depending on the choice you make. You have to aggressively ignore sunk costs, because those are past expenses you can never recover, no matter what you do. And you need to evaluate opportunity costs, which is the value of whatever you're giving up by choosing one option over another. Doing this cuts out all the accounting noise and lets you focus strictly on what changes your bottom line. To really interpret all of this effectively, we use something called trend analysis. Think about it. A standard balance sheet or an income statement is just a snapshot. It's a static photograph of one single moment in time. Trend analysis connects that data across multiple periods. By comparing your margins, your inventory turnover, or how your expenses evolve over time, you turn that static photograph into a dynamic, strategic movie. It reveals the hidden patterns, like if your company is genuinely becoming more efficient, or if you're just slowly accumulating hidden waste. Which brings us to our final section, the managerial cycle, the engine of decision-making. We've got the tools, so let's see how management actually uses them systematically, day in and day out. This is the practical pipeline for moving from raw data to an actual decision. Step 1, what data do we collect? You definitely shouldn't collect everything. You prioritize information that's tied to strategic goals, like product costs or projected cash flow. Step 2, how do we get it? This is where you integrate your production, sales, and finance systems, usually with an ERP or some highly structured spreadsheets. And step 3, how do we present it? You use visual reports, variance analyses, and KPIs. That way, a manager can instantly understand the story without getting totally lost in the raw numbers. And that pipeline feeds directly into this continuous, repeatable managerial cycle. Plan, execute, measure, adjust. You plan your goals, you execute the work, you measure the performance against your budgets, and then you adjust course wherever necessary. This isn't just a one-off thing you do at the end of the year, it's a constant, everyday loop. And honestly, mastering this continuous cycle is where a company's sustainable competitive advantage truly comes from.
So are you ready to stop guessing? Managerial accounting isn't going to hand you magical answers, but it absolutely gives you the method to go out and find them. It democratizes the language of business, it trains you to think in real cost, to value the time of your money, and maybe most importantly, to separate your emotions from the hard numerical evidence. Look, in a business world where uncertainty is basically the only guarantee, the winner isn't the person with the most data. The winner is the one who converts that data into precise, decisive navigation. So I'll leave you with this to chew on. In your own daily operations, where are you still relying on your gut feeling? And what single metric could finally help you clearly see the road ahead?